previous section, we examined compensation for employees, including fringe benefits as well as stock benefits. In this section, we're going to look at retirement benefits, specifically how employers and individuals can save for retire, and how the tax code creates advantages in doing so. This affects the compensation because it's a deductible expense, as well as the exclusions to income. In a subsequent chapter, we'll examine the role of this retirement income. One way in which the tax code encourages employees to save for retirement is by allowing employers to offer qualified retirement plans. These plans allow for a portion of an individual's salary to be set aside for retirement purposes before tax is computed on the remaining salary. Any earnings on the contributions are not taxed. The only time that tax comes out is when the retirement proceeds are distributed. Any such distributions are recorded simply as ordinary income in the income section on the 1040 form. Now, there are some restrictions in qualified retirement plans. An individual who begins to draw proceeds from the plan before age 59 and a half faces a steep penalty. In addition to the tax consequences of receiving the income, they also are subject to a 10% penalty. Also, an individual must begin receiving distributions from the retirement account by age 70 and a half. The entire plan interest, or the growth on the original contributions, must be received within a specific time period that's specified and calculated by actuaries. There are several types of employer-provided plans. The first, which is not as popular anymore, is the defined benefit plan, which is a pension plan wherein participating employees are promised a targeted benefit when they retire. Any contributions to this plan are deductible payroll expenses. However, the maximum compensation is limited under an employer-provided plan. It's limited to the lesser of 100% of the retiree's average compensation, or of $220,000. More popular these days are defined contribution plans, wherein individual contributions are withheld from the employee's paycheck or made from the employer's matching funds. The retirement trust maintains a separate account for each participating employee, and the employer agrees to contribute a specified amount to each account. However, the annual contributions to such a fund are limited by the tax law to the lesser of 100% of the annual compensation of an employee, or the annual base amount of $55,000. Another type of employer-provided plan is a deferred compensation plan. Although this plan isn't a retirement plan per se, it is an agreement between the employer and the employee to provide a specified amount of salary at a different date. The employer does not deduct these contributions because no cash is exchanged. It's simply a promise to pay in the future. Accordingly, the employee does not recognize income until he or she actually receives the deferred compensation. The promise to pay is simply that, a promise. Finally, for self-employed individuals, the tax code code allows the individual to make retirement contributions before they compute their adjusted gross income. Any growth of such contributions is tax exempt. The amount of these contributions are limited to 20% of self-employment income, or that same base amount adjusted for inflation. So let's test your comprehension of the taxable value of stock options. As we said, certain retirement benefits through employee-sponsored plans are potentially subject to penalties for early withdrawal. Let's test your comprehension to see under which cases this applies. First, if Rachel is 45 years old and withdrew the money from a personal savings account, what is the tax cost of the withdrawal? In this case, the answer is nothing. She deposited the money into a savings account after taxes had already been deducted. So any withdrawals from the savings account are made tax-free. Under the second circumstance, Rachel is 56 years old and withdrew the money from the Bloomingdale-sponsored plan upon her retirement. On the one hand, Rachel is below the minimum age of 59 and a half, wherein she can make withdrawals without penalty. However, another exclusion to this plan allows for an employee to make early withdrawals if they are actually retiring from the company. Since Rachel is 56 and she's withdrawing the money upon her retirement, the taxable cost of the withdrawal is also zero. Finally, Rachel is 56 years old and withdrew the money from the Bloomingdale-sponsored plan prior to her retirement, so she intends to work. In this case, she's below the minimum age of 59 and a half, and she's withdrawing the money prior to full retirement. Therefore, whatever money she's withdrawing is subject to a 10% penalty. In addition, she must also pay taxes at her regular marginal rates on the income that she's realizing from the early withdrawal. There are also a number of retirement opportunities that an individual can participate in without participation from their employer. Two of the more popular are Roth IRAs and traditional IRAs. In a traditional IRA, you can deduct any such contributions before you figure out your adjusted gross income. However, the tax code limits the amount of contributions that a person can make. Those below age 50 can only contribute $5,500 to their traditional IRA, and those above 50 can make an additional catch-up contribution. The contribution itself cannot exceed 100% of compensation or 100% of self-employment income. And any contributions made to an IRA must cease by age 70 and a half. The Roth IRA is different in that any contributions to the retirement account are made with post-tax dollars, so money that has already been taxed. Any earnings that the account makes are tax exempt, meaning that upon withdrawal, the individual doesn't face taxes. The limitation to the Roth IRA is the age limit. The tax-free contribution limit begins to phase out above a certain adjusted gross income level, as stated below. When figuring taxable income, contributions to a Roth IRA are made using after-tax dollars. Therefore, any such contributions are non-deductible. With a traditional IRA, deductibility is dependent upon active plan participation. If the contributor is a member of another plan, any contributions below an AGI phase-out threshold are fully deductible, and the amount of the qualified deduction phases out above this threshold. For non-active plan participants, such contributions are fully deductible. When withdrawing funds from an IRA, Roth IRA withdrawals are not subject to a minimum distribution. You don't pay taxes on the distribution, and you don't have to draw a specific amount each month. With a traditional IRA, withdrawals must begin no later than April 1st of the year after the plan holder turns 70 and a half. These withdrawals are subject to a minimum distribution requirement, and there's taxes only on the gains above the contribution. As with employer-sponsored plans, withdrawals from a traditional IRA are subject to a 10% early penalty if the withdrawal is made before. So now let's check your comprehension about how much of a contribution is allowable under the following circumstances. Circumstance number 1. At 25 years old, Rachel left her fiancé at the altar and showed up on Monica's door. Her only income item is $13,200 from a trust fund. The answer in this scenario is 0, because IRA contributions can only be made from earned income, income that comes from one's salary, or income that comes from one's self-employment. Income from a trust fund, as is the case here, is not appropriate for such a contribution. Item number 2, if Rachel is 40 and single and her only income is her $120,000 salary from Bloomingdale's. In this case, Rachel is held to a $5,500 contribution to her plan. The whole amount of that $5,500 is deductible from her taxes. Finally, if Rachel is 51 years old and her only income is her $120,000 salary from income, she is allowed to contribute $6,500 to her plan. The $5,500 that anybody can contribute, plus a $1,000 catch-up provision. The full amount is deductible, provided that she's a non-active participant. In this unit, we examined the tax treatment of retirement compensation provided by employers, as well as the tax treatment of individual retirement contributions. In Chapter 16, we'll examine the tax treatment of investment income,